part 4 of our discussion relates to valuation and tax issues. The first question that I often get from founders when they're looking at raising money is, how do I set the valuation of my company? What's my company worth? And, you know, I don't know how to answer that. I can come up with some common metrics about how to arrive at a valuation, but we're talking about an idea stage company. Or maybe it's been formed, and maybe it has an alpha, or maybe it has a beta. Who's to say, if Dave, if you say that's worth $1 million, that's $1 million idea. Everyone throws that around. Maybe you're right. If I told you no, I think it's worth $1.5 million, maybe I'm right. I don't know. What do we think about? Well, there's comparable, you can look at comps, right? Comparable entity and industry analysis. If you can find them, right? What's a comparable company to a startup that's in your space? If you're a fintech that's doing algorithmic trading, you know, how many comparable companies are you going to find? Right? You're not comparable to Bear Stearns or you know, Goldman Sachs, I should say, right? Like, so how do you find that? Book value, value the assets or multiples. Book value isn't really the right way to value a company. An investor might say, well, you know, whatever you paid for, that's fine, but that doesn't take any account of any intrinsic value, any value that you've created yourself or the value of the intellectual property. Multiples of what? You know, of earnings? You don't have them. Of losses? All right, maybe that's a way we could get to. I think multiples require assumptions. You cannot do a discounted cash flow analysis on a startup company because it's all assumptions. And if it's all assumptions, then you know, basically we're just making it up. Intrinsic value, you know, that's kind of the personal value to the company. What does a founder feel that's worth? You know, really what this comes down to is a negotiated or backed in value for the most part at the very early stage of a company. Now this changes. When the company has its legs and has revenues and has, you know, earnings for a few years, very different analysis. But at the first year to 2 years, what we're really talking about is how much money does the company need, right? And then how much are you willing to give up for that money, right? And with those two metrics, you come up with a valuation of the company, right? It's really that simple. How much should it take? I think a rule of thumb is 18 months of operating funds is what a company should take. There are a lot of reasons to vary from that, and I was advising a startup to vary from that just the other day. But 18 months is a good rule of thumb to think about what your financing round should do. And this way you can have 12 months of runway, 12 months of runway in order to operate the business, and then start to look for your next round. Because it could take up to 6 months to do your next round, so you want to prepare for that. Do not think that you're going to find a round and, you know, and close that inside of a month or two. You might be able to, but that's not a great way to plan the future of the company. Pre-money valuation and post-money valuation are terms that we throw around a lot. I just think it's worthwhile to explain what those are. Pre-money is really simple. It's the enterprise value before anything is invested. What do we think this company is worth right now? Right? Is it $1 million, $2 million, $3 million? Post-money, take what you was before, add on the new money, simple math, you have your post-money valuation, right? So a pre-money valuation of $5 million, right, plus an equity infusion, let's call it a Series A round, of $3 million, you come up with a post-money valuation, your first round of money, of $8 million, and hopefully $8 million now becomes your new pre-money, right? Or at least, you know, at least that. It doesn't go lower than that. And you have an ownership result with the Series A investors, right? They're getting 3 of the 8, or 37.5%, and the founders still have 5 of the 8, which is 62.5%. Okay, so we've taken the $8 million, and we've, you know, more than doubled the valuation. It is now a $20 million valuation. We're going out for a Series B round, and we're going to sell 10 million of our Series B so that our post-money valuation, it will be 30 million. Once again, right, the investors will represent, the new investors of the Series B will represent 10 of the 30. The Series A will be diluted down to 25%, and the founders will have 42%, and the Series B will come up with 33%. Okay? Just natural dilution.
You know, I want to add something to that and tie it to some of the other things we've discussed today. If you're founders, right, and you have 3 or 4 founders of your company, remember you've already diluted yourself from day one of your company. So look at the percentages that Charles is talking about here. You know, the founders are now grouped in, what is it, 42% of the company? What if there are 3 or 4 founders? That means you're already at 10, 8% apiece, and maybe you need more money in the future. You're getting more diluted. Now, hopefully the company's really scaling, right? So I think it's a big point to always remember, when you start a company, you know, be very mindful of what people are adding as co-founders, and be very careful about apportioning equity to other people. You know, vesting is certainly a big part of it, but the amounts themselves. Some people point out that you never get more diluted than you do on day one of the company when you give away half the company to somebody else. So think about that as well.
And you could see, if you run through this analysis, what happens. So pre-money valuation, let's assume it's $5 million. You infuse equity on 3, that's what we're talking about, right? And we have shares of common stock outstanding are 2 million. So what we're doing, 5 divided by the 2, right? It's a price per share of $250. If you then infuse an option pool of $480,000 afterward, right? The result is no effect on the price per share of the Series A stock, right? So what happens is that you've still paid $250, the investors still paid $250, and the founders haven't been diluted for this option pool. There's no effect. Right? The founders are diluted by the option pool pro rata. Right? Now take a look at, so the price per share is increased. So take a look at the opposite, right? So if you do the pre-money valuation of 5, the equity infusion of 3, common stock outstanding is 2 million, right? And then the shares are reserved. The result is a price per share of $2.02. The price per share is reduced, and the founders bear the dilution of the ESOP pro rata. So what they've done is they've shifted the option pool to the founders. Okay? And that happens all the time. And by the way, I'd be remiss if I didn't say that you should expect that. It's commonplace. I wouldn't negotiate against that type of dilution, but it's the amount that is negotiable, really. Right? So the market will expect that the founders are going to be diluted by the option pool, and the market will also expect that the negotiation is about the amount, right? Not whether or not there is one.
Just wanted to ask you about the option pool. So do the employees, I know this is very basic, but do the employees purchase them at that option price, or are they just given it as part of their package?
Yeah, it's a great question. So the options are awarded to the employees, and they will have an exercise price. So in order to get the stock that the option represents, you will have to pay an exercise price per share. So let's say the fair market value of a share of common stock is $1, and you have 100,000 options. If you want to exercise, you have to pay the company $100,000. So in the early stages of a company, the exercise price is probably not $1, and the common stock of the company is probably not worth $1. It's probably worth much lower, right? As the company increases in value, it will have what's called 409A valuations, right? And it's a different part of the discussion a little bit later, but what will happen is an independent provider will tell you what the valuation is of the company, of the common stock, and that will set your exercise price. It's not really a subject of negotiation for the employee. The employee will have an option, and they'll be able to exercise it by paying that price.
But actually, so I'm actually facing this in my company right now, and we haven't raised any funding so far. So the question that most employees ask us is that, does that expire? Can we wait until there's actual value in that option? And not just like, theoretical value. I
don't know what your option pool says, but most option pools that are intended to have options that are called incentive stock options and gain favorable tax treatment will have a 10-year expiration period on your options, right? Or also you'll probably need to exercise them within 90 days of termination. So after you leave, you exercise it or you'll lose it within 90 days. Once the option is issued, right, it will be deemed to be outstanding. When you calculate what's outstanding on a fully diluted basis, you will include that in the calculation. That is often not part of the discussion that you will have with investors as to what ought to be reserved as an option pool. The problem with the reservation is that it's not issued, right? And so you're reserving a speculative amount of shares to be reserved, but we're assuming that the valuation, we're assuming for purposes of valuation that these are issued and that you have issued them so that the founders then pay for them. It's an assumption that these have been issued when we're actually valuing the company.